You've probably heard it a million times. For a company to do well, it has to do good. But what if doing good actually comes with a hidden price tag? Today, we're digging into the surprising, true cost of corporate sustainability.
It's a really popular idea, right? That the companies focused on sustainability are also the most profitable. But is it really that simple? Is it possible that the market could actually punish a company for trying to do the right thing? Well, let's take a look at the evidence.
So, first, let's unpack that popular belief. This seemingly straightforward idea that being a good corporate citizen is a one-way ticket to bigger profits. The logic usually goes something like this. A high ESG score, which, stands for environmental, social, and governance, is a signal of a well-run, forward-thinking company, and that should mean a stronger bottom line. But a recent study is suggesting that the reality is, well, a whole lot more complicated. To really get to the bottom of this, researchers took a pretty fascinating approach. They decided to put this whole idea to the test in a really high-stakes environment, a major bank in an emerging economy. Okay, so here's the lab, so to speak. Researchers Mohammed Kaya and Şeyda Ertuğrul zeroed in on Halkbank, which is one of Turkey's biggest state-owned banks. They crunched 15 years of data, looking at two key things that affect profitability: the bank's efforts in sustainability and how risky the market perceived it to be.
All right, first, let's get a couple of terms straight. You've got the ESG score. The easiest way to think about this is like a company's sustainability report card. It's rating how well they're handling environmental risks, how they treat their employees, and whether their leadership is ethical. In theory, a higher score is always a good thing.
And the second term is CDS spreads. Now, the full name is credit default swaps, but don't worry about that. Just think of it as the market's anxiety meter. The higher the CDS spread, the more worried investors are that a company might not be able to pay back its debts. It's a direct measure of risk. So, with those two ideas in our back pocket, let's look at what the study actually discovered, because this, right here, is where that simple, popular story starts to completely unravel.
So get this, the first huge surprise from the research is that any big change in the bank's ESG performance, whether it was getting better or getting worse, actually ended up hurting its profits in the short term.
And this is where it gets really interesting, because it reveals this costly asymmetry. Improving your ESG score hits your profits a little bit, and that's probably because of the upfront costs of new investments, but letting your performance slip, that hits your profits way harder. And why? Because investors see that as a huge red flag, like a sign of bad management or a broken promise, and they punish the company for it. So the bottom line is, becoming more sustainable isn't some kind of free lunch. Things like investing in green technology or improving how you treat your workers, they have real, upfront costs. The study makes it crystal clear. These initiatives force a short-term trade-off between doing good and the company's financial performance. But the story doesn't stop there. The researchers decided to add another layer to their analysis. They asked, what happens when the entire market is stressed out and panicking? See, they didn't just look at the 15-year average. Using a pretty sophisticated model, they were able to separate all that data into two totally different market environments, or what they call regimes. The easiest way to think about it is calm seas versus stormy seas. Calm markets are when things are stable and low risk. Volatile or stormy markets are those periods of high stress and uncertainty when everybody's on edge. So the big question is, does this change the impact of ESG? And the answer is a huge, resounding yes. You can see it right here in the data. In a calm market, the negative hit to profitability from these ESG activities is relatively small. But in a volatile market, whoa, that negative impact becomes nearly 3 times worse. And this is the second massive takeaway here. When the financial system is already shaky, the costs and the pressures of just maintaining or improving these sustainability programs get magnified. The burden just becomes so much heavier to carry when you're in the middle of a crisis. So what does all this mean for the real world? Well, what these findings show is that banks, investors, and regulators are all walking a very, very fine line. It's like a sustainability tightrope. For banks, it means managing ESG isn't just about setting goals, it's about timing. If you try to force huge changes during a downturn, it could seriously backfire. For policymakers, this suggests that pushing for sudden, aggressive ESG rules could actually destabilize the very system they're trying to protect. A slower, more gradual approach might be much wiser. And for investors, it's a reminder that a company's journey to sustainability is rarely a smooth, straight line upwards. And the researchers themselves basically conclude that this is the most sensible path forward. A gradual approach lets banks build up their ability to be sustainable over time, without having to risk their financial health to get there. It's really about evolution, not revolution.
And all of this leaves us with a really challenging question. We know sustainability is crucial, but this study shows it comes with real costs, especially when times are tough. It forces us to ask, how do we balance our long-term goals for the planet with the short-term financial stability we need right now? The answer, it seems, is far from simple.